Good afternoon and welcome to the second session of the Autumn Term Money webinar series by the Institute of International Monetary Research in collaboration with the Vinson Center at the University of Buckingham. I'm Dr. Juan Castañeda, Director of IIMR, and today we'll be hosting Professor Hans Werner Sinn. Hans Werner Sinn has been full professor in the Faculty of Economics at the University of Munich since 1984 and Professor Emeritus since 2016. Since then, he has been an active contributor to public policy debates and the challenges affecting the Eurozone economy, including newspaper articles, interviews, and television appearances. Since 2017, he has been a permanent visiting professor at the University of Lucerne, and at the turn of 2019 and 2020, he became head of the Regulatory Committee of the Bavarian Economic Council. Professor Sinn studied economics in Münster and completed his doctorate and habilitation while serving as lecturer in Mannheim. He has visited and taught in several universities and conducted research in Germany and abroad at the universities of Stanford, Princeton, and the LSE, among others. Since 1988, Professor Sinn has been an honorary professor at the University of Vienna. He has also received honorary doctorates from the universities of Magdeburg, Helsinki, Prague, and Leipzig, as well as numerous international prizes and awards. In 1999, Professor Sinn founded the Center for Economic Studies at the University of Munich. And from 1999 to 2016, he was president of the IFO Institute for Economic Research. From 1997 to 2000, he was chair of the Association of German-speaking Economists, and from 2006 to 2009, president of the International Institute of Public Finance. He's also fellow at the National Bureau of Economic Research in the US. Professor Sinn has published more than 30 monographs and over 140 scholarly articles. His latest book, The Economics of Target Balances from Lehman to Corona by Palgrave, will be available in November this year. Professor Sinn will discuss today target balances, after which we will allow for time for Q&A with viewers at home. Today's presentation will be recorded and made available on our YouTube channel, where you can access his presentation along with the previous ones in the series. Questions must be submitted via the tabbed option on Teams, and I will moderate them and address the speaker. Professor Sinn, we are really grateful for your continued collaboration with the Institute, and we are delighted to host your talk today. You have been one of the few who raised the issues related to target imbalances and fostered public discussion on this issue very successfully in the past. This is a question that deserves attention, and it is precisely the topic of your lecture today. We couldn't think of a better person to tell us more about the topic. So thank you very much again, and the floor is yours, please.
Yeah, thank you, Juan, for the invitation, and everyone for participating who is listening now. This is the book title, The Economics of Target Balances from Lehman to Corona. There's a little bit of Corona, but the manuscript had to be delivered after the new crisis had just started. I want to explain what this difficult issue is. Some say it's an irrelevant accounting item without any meaning, and actually politicians like that. And the one or the other economist has voiced a similar opinion. Others have emphasized how important the target balances are, and let's see what it really is. Prima facie, it's a system of public payment orders from one country to another. It's an acronym. It's not worth learning what it really means. Target has nothing to do with the target at which you aim. Sometimes it is said that it is a target 2 system because there was a target system before. But as I explain in my book, I don't want to go into it. The differences are completely irrelevant for the basics of what is going on. What are target balances is my question. They are international payment orders and liquidity transfers between countries. Knowing this, they are very useful for understanding the various phases of the euro crisis, including the final corona crisis. And then the question is, are there any risks involved? What is really happening in real terms if we look at the true economy behind it? And what are the policy conclusions is my final question. So let's first look at the statistics. I have here a graph that starts at the beginning of the Eurozone with the year 2003. And it shows the target balances for Germany in the upper part of the diagram. These are positive. And for a group of countries lumped together, Greece, Ireland, Portugal, Spain, Italy, and Cyprus, which used to have and still have, to some extent, very huge target balances. And as you see, the most recent figure is a target claim of the German Bundesbank of more than 1,100 billion euros and more than 1,000 billion euros as an accumulated target debt of these other countries. The target claims and liabilities are reported in the national central bank's balance sheets. It's a little bit difficult and tricky sometimes to find them because there is no open and uniform labeling, but that is not the issue. No one disputes that, and it's very clear. There is, of course, more to be said about it. If we look at the most important countries in terms of the size of the balances, you have here Spain with a target liability of nearly 460 billion euros now, and Italy with a target liability of more than 500 billion euros. These two curves are included in the lower curve here. But then there is a curve for the ECB. The ECB has negative balances because it actually makes payment orders to buy assets from the rescue programs, which are issued in other countries of the Eurozone. And then there's the Netherlands, for example, or Finland, or Luxembourg, and all the others I could add here, but most of the others are pretty close to zero, including France, so it's not interesting. The big players, the music here in this concert is played by Germany on the one hand and the six named countries at the lower part of this diagram on the other hand. Now, what are target balances? They measure the stocks of accumulated net payment orders booked in the balance sheets of central banks. These payment orders have been made for various purposes, for buying goods and services abroad, for paying interest to other countries on debt which had been taken before, including actually paying interest for the internal interest payment and pooling system in the Eurozone. In principle, the interest revenue, the seigniorage collected by the national central banks is pooled and then redistributed to the national central banks, and from there the seigniorage goes to the respective nation states. And if there are net interest flows, they also are booked here in the target balances. Then payment orders can be done for giving credit to other countries, for redeeming debt taken in earlier days. For example, if there is a capital flight and the creditors want their money back, or for buying outright purchases of assets in other countries. So there are various motives for these international payment orders. And of course, the same occurs when we look to a target creditor country, then only the signs are the reverse. If we want to understand in terms of economic aggregates what it is, then target liabilities are resulting from current account deficits. The target liabilities are stocks and these are flows, so it's the accumulated flows, but they also result from private capital exports from the target deficit countries to the rest of the world, resulting from these three motives. So basically, it's current account payments and capital account payments, which are reflected in the target balances. Now, in order to go on, we first have to understand what a payment order is. This is not so obvious to everyone, so let's look at an example. So go back to the United States, say to the 19th century, before there was a Federal Reserve Bank. There was a bank in Detroit, the D Bank, which made a payment order to a bank in Chicago, the C Bank. Why did it do so? Because there was a buyer in Detroit who wanted to send money to Chicago in order to buy something from a seller. So the buyer's account with the D Bank is being reduced. The D Bank makes a payment order. It sends a letter to C Bank, tells C Bank, please, on my behalf, pay out a certain sum of money to the seller. So that's a payment order. Typically, this results in some wealth transfer between D and C, because if nothing else happens, then C, by being so kind as to carry out the payment order for D, gives D a credit. Often the credit is standing, but there are limits, and if the accumulated sum of credit becomes more, or after a certain period of time, then one would typically settle that, and the D Bank would have to send some real asset to C in compensation for the payment order. For example, it sends gold, and you know this from your Wild West movies from our childhood when we saw that. The gold is being transported through the countryside in order to settle these payment orders and the credit relationship resulting from the payment order. But of course, this was dangerous. The robbers, the bandits were coming, and so it was a cumbersome system. That was the reason why in 1913 the Federal Reserve Bank was founded, and then someone had the clever idea, let's put all the gold on one hip with the Federal Reserve Bank, and then we just book the ownership in the stock of gold between the banks making mutual payment orders to one another. That is the settlement process, and that settlement process lasted until 1975, and after that the settlement was done with marketable assets rather than gold, but gold was originally being used. So you see, if there is not this asset transfer, the payment order is a credit. The bank carrying it out on behalf of another bank gives this other bank a credit. Now, what do we have in Europe? In principle, when the euro was set up, there were various possibilities for setting up a European payment system. First of all, it could have been private. There's nothing in the treaties that says that it needs to be a public payment system. Private banks could mutually give another credit, as in the example of the situation in America before the Federal Reserve Bank was founded. Or it could be a truly European public system where the national central banks are just branches of the euro system, and all assets which they accumulate from money creation belong to this central bank in Frankfurt, the ECB, which itself would be owned by the EU. And a payment order would just be shifting accounts with this central bank from one national central bank to the ownership of another, but there would always be the assets in the ownership of the central bank. That was not chosen in Europe because the national central banks wanted to keep their independence, and after all, the assets belong to the nation state, and one did not want to mutualize this. So another possibility considered was national public with a transfer of monetary assets. So what one could have done is saying that in the moment a payment order is being made from one central bank to another one, the ordering central bank gives monetary assets, which it itself acquired on the when it issued the money in the first place to the private sector, to the other central bank, or to the ownership of the ECB, and then the others get an ownership in an indirect ownership in that. But that was not done either. That is not the European system. The European system is truly decentralized without this asset transfer. It's national public without the transfer of monetary assets. National central banks remain owners of the monetary assets they acquired when issuing the money in the first place, even when they carry out the payment orders. So these are open positions, and therefore they are credit in the same way as there was a credit between the Detroit bank and the Chicago bank in my previous example. They are a sort of overdraft credit between the national central banks because there is no limit, and a national central bank making the payment order can, in a sense, draw credit from the euro system. It is an overdraft credit. And there's even possibly interest on it, which is a somewhat tricky issue. I come to that later. A country's target deficit, therefore, is a public capital import, because the other central bank in the euro system is a public institution which gave credit to the central bank which runs a deficit in the target balances. A deficit matching the current account deficit and a private capital export, for example, through capital flight, as I had explained. And correspondingly, the target balances are booked in Eurostat's accounting system as part of a country's net foreign asset position. That is the net wealth one country owns in the rest of the world, taking everything into account: direct investment, financial investment, debt, and so on. Just to return to the Bundesbank's target balances, these 1,116 billion euros target claim happens to be, in the moment, exactly 50% of Germany's net foreign asset position. Net foreign asset position normally is the result of current account surpluses of the past, which are accumulated, minus devaluation losses and so on, but in principle they result from current account surpluses. We had in the economic literature similar phenomena discussed in the past. The IMF drawing rights are a little bit similar. These are also overdraft credits, but with a limit. Or Keynes' Bancor artificial currency for international payment orders are basically very similar to the target balances. Or take the Soviet system, which had a target-like system with rubles. It had huge deficits of the periphery states in the Soviet Union, and when the system broke down, the Soviet Union had unsettled claims on the other states in the Soviet system, which were never settled then. Claims were large, in the order of 70–80% of GDP of the periphery states. And foreign currency reserves in fixed exchange rate systems, like the Bretton Woods system, also have a lot of similarity with the target balances. Because it was a fixed exchange rate system, central banks had to intervene, and so it happened that one central bank was accumulating the currency of another central bank, which then later could be exchanged in that system into dollars or into gold. And often it was gold because the exchange was at a given parity, and the market price of gold happened at that time to be rather cheap. So that's the reason why the Bundesbank in the Bretton Woods system accumulated a lot of gold from the equivalent of its target balances. Actually, if it was 4,000 tons, and if we convert the current target claims at the current gold price, it would be 20,000 tons of gold, which is 2/3 of the gold owned by all central banks of the world. Just to give you an idea of the magnitude, and that this is not really an irrelevant issue. In addition to electronic payment orders across the borders, there are of course physical transports of cash across the border, which generate cash balances, which are very similar in very many respects to the target balances. The book has a full chapter about it. I don't want to go into the details here because we don't have the time. These payment orders are, of course, liquidity transfers because it originates, say, from a bank in one country, making the payment order to another, and by making the payment order, the liquidity there is withdrawn. So the central bank in this respective country is being reduced, and in the other country, it is being increased by the same amount. I distinguish between two kinds of central bank money: internal and external central bank money. Internal central bank money is money circulating, central bank money circulating in a country, which originated from credit operations, including asset purchases at home. And external money is payment order money, where the respective credit operations took place in another country of the Eurozone, and the money is nevertheless there because of these payment orders, which the central bank fulfilled on behalf of another central bank. It is important to keep that in mind because it is clear if liquidity leaves the country because maybe the situation is considered insecure, then banks shift as much liquidity and central bank assets, central bank money to other countries, that the liquidity in this country from where the payment orders comes shrinks. It may dry out if there's too much. So that's the problem of capital flight to another country, a deposit flight. Then the liquidity would shrink, and if it goes beyond a certain limit, which is needed for transactions, this country is really in trouble. And so there is a relationship between the extra money being issued through credit operations in a deficit country and the amount of target balances. If the stock of liquidity is already low, it is difficult to send liquidity to another country, and it's actually only possible if the same amount of liquidity, new liquidity, comes through credit operations. It's like a pond where there's a river or a little creek, and the creek sends money into the pond. Of course, it can accumulate, but the amount of money that flows out of this pond into another pond is actually the target flow, and it is indirectly related to the inflow. Not exactly, because the volume of the bond can increase or go down, but basically the inflowing liquidity explains the liquidity that can go out of the bond. And therefore, a negative target balance may only arise if local money creation credit issued by an NCB beyond the amount necessary for domestic circulation takes place. We have seen a lot of money creation during the crisis, right? So there was symmetric and asymmetric credit operations. Symmetric credit operations were, for example, the public sector purchase program and the new pandemic emergency purchase program, which will amount to more than 3 trillion until June 2021. Basically, every central bank buys government bonds and other bonds in proportion, government bonds in proportion to the capital key, and that is a measure of the relative size of the country. So money is being augmented equally everywhere. But still, that doesn't mean that it stays there. If this excess liquidity flows to another country, there will be target balances. If there is no excess liquidity, as I said, it's very difficult to finance target balances, liquidity flows. But if there is a lot of excess, lots of liquidity can flow. And it can also be asymmetric. So the countries, the national central banks have a lot of possibility not to symmetrically issue central bank money, but they can issue more than would follow from their relative size. There are various mechanisms through which this has taken place in the Eurozone. The first is that the collateral standards framework set up by the ECB is a very broadly defined system, which gives a lot of leeway and scope for national definitions of acceptable collateral for central banks. So when they carry out their refinancing operations and receive collateral in exchange, it's the question, what kind of collateral? Actually, the collateral standards in this crisis have gradually been reduced, so that when banks of a country were short of good assets which they could use as collateral, then the collateral quality has been reduced, and it was up to the local regulators, actually, that can be shown, which have co-defined the amount of assets eligible for collateral. It was not only the central bank in Frankfurt, the ECB Council, broad framework, yes, but there was a lot of possibility and scope for the individual countries. Then there is ELA credit, emergency liquidity assistance. This is meant to be asymmetric. So if the central bank says we have a case of emergency, it is allowed to print extra money and lend it out to the local banks as refinancing credit, unless 2/3 of the ECB Council vote against it. But it doesn't have to ask whether it can do that. It can do it. It has the right to do it, and the others can stop it if 2/3 come together. But in the critical years, the deficit countries had one vote more than 1/3. So if they wanted that, no one could actually stop that. And then there is ANFA credit. Agreement on Net Financial Asset is the, this is an abbreviation of this, which gives national central banks a lot of scope actually to buy assets in the market for their own purposes, and use the returns to distribute them to their states. Not fully, return equal to the main refinancing rate has to go to the pool, but any extra return would be theirs, and they could use it for their own purposes or the purpose of purpose of the respective nation state. And these ANFA assets had been huge, hundreds of billions of euro. So all this excess or symmetric money creation in excess to the minimum needed for transactions and local extra money creation in asymmetry enabled payment orders to other countries. This extra money creation was actually used for various purposes. It compensated for and enabled capital flight by foreign investors whose credit claims became due and they didn't want to roll over the credit, so they wanted the money, and the money came out of the local money creation operations. Also, it could have been the case that the money from this local central bank was available at better conditions than in the market. Actually, otherwise banks would not have taken this credit. Better conditions in terms of interest rates and in particular in terms of collateral being accepted. And it may also be the case that this low interest and bad collateral credit being available encouraged and enabled purchases of assets or goods abroad, which may explain some of the target balances. To see what kind of asymmetry has been created in the Euro system, look at Germany. This is Germany's monetary base in September. And this here is that part of the monetary base, which is internal money, according to my definition. That is money being created by the Bundesbank through credit operations, refinancing credit and asset purchases from banks. And the rest is payment order money, that is external money. And it's quite sizable. At the peak of the Euro crisis in 2012 and 2013, this was the entire stock of money balances in Germany. All of the internal money coming from the Bundesbank's own credit operations had been wiped out because banks which had an excess of liquidity in Germany used this extra liquidity to pay back refinancing credit, given that they had already this payment order liquidity. You know, they didn't need the refinancing credit anymore and they wanted to save interest and repaid that credit. That was 100% of the monetary base in Germany. Actually, a similar figure can be drawn for Finland. It was similar. But thereafter came a period of much money creation, and now the things have normalized a bit in relative terms, but not in absolute terms. The amount of external money has increased and increased. There's a metaphor which I like, and you saw already a banknote here, which does not fully describe this exactly, but gives you an idea. Suppose we would consider a banknote as an envelope, and we open this envelope, and this is a euro banknote. Outside it says euro, and inside the envelope there are the old national currencies. Suppose there are Deutschmarks, Escudos, Pesetas, and what have you, depending on where the central bank first was being created in the euro system through credit operations. And if we would do that, we would find that the blue curve gives us the Deutschmarks circulating in Germany. And the difference between the two curves, the external money, would have envelopes with money coming from other countries. But of course, it's only a metaphor, which is not fully correct, but halfway correct. Just to give you an idea of the amount of asymmetries that has developed in the Eurozone. Let's now return to the initial diagram of the increasing target balances to understand what happened in the Euro crisis. So here, until 2007, the balances were basically zero. There were overnight imbalances, but not very much more. That was the period when the European economy went well, it seemed, but in retrospect, we know it was a bubble. Credit had become very cheaply available to countries which formerly had very, very high interest rates, the Mediterranean countries in particular, and this low credit meant that there was an economic boom in Spain through building and construction activities. In Greece, it was more through the government sector, which was able to borrow and pay pensions and wages to government employees and so on. So foreign credit money was flowing into these economies, igniting an economic boom, generating inflation, because it generated wage increases which went beyond the productivity increases, and so the relative prices increased. The North was not inflating, but the South was inflating, and that deprived the South of its competitiveness, a problem which they suffer from up to this day. And something has been corrected. There was a correction in Spain and in Greece, but it was not probably enough, and there was very little correction in Portugal and Italy, for example. Anyway, there was the bubble. Then came the Lehman crisis. 1 year earlier, the interbank market in 2007 had already broken down. So let be this the beginning of the new phase. That's now a period of capital flight and a sudden stop of capital flows. These countries had current account deficits, and the current account deficits needed to be financed. In the phase zero, there was no problem finding external finance for these current account deficits, but now the capital was reluctant to continue financing the current account deficits, and even it wanted to retreat and get back home. So it was a combination of a sudden stop, but it was and an outright capital flight. And for both reasons, these target balances emerged. You know, the current account deficits needed to continue to be financed, even though there was no foreign credit money coming in, and also the foreign creditors wanted their money back. So there were payment orders from the crisis countries to the north, and I show here Germany, but it includes also other countries of the north. Then came a new phase after the summer of 2012, when Mario Draghi had said it's whatever it takes. Markets calmed, and they were again considering investments in the South safer, and new investments were coming, meaning that there were payments orders from the north to the south, reducing the target balances. The negative balances and the positive balances, both in absolute terms, became smaller. And then came a new phase, which I call liquidity abundance, the QE phase. QE began in 2015, a huge program for buying assets from banks, which had bought these assets before, government bonds, the bonds of rescue programs like the ESM, EFSF, and so on, and also private obligations, which were bought by the central banks in this program. So a lot of symmetric, more or less symmetric money came into the European economies and created this effect, which I described before, that if there is more liquidity than needed for transactions purposes, it is possible to use it for purchasing assets and goods elsewhere, basically assets elsewhere in the Eurozone. Then came a very interesting, though short phase, which can be seen in the data. This was the tiering decision of autumn 2019. You know, the deposit facility had already a negative rate of interest of minus 0.5, and now the ECB decided to introduce brackets or tiers of deposit money, which banks held with their central banks, for which the deposit rate, the negative deposit rate or the penalty rate, one could say, would not apply. And as the liquidity had assembled in the north, the northern banks were beyond the bracket. So at the margin, they did have to pay this penalty interest rate, while the southern banks were below the brackets. The brackets were large, 6 times the minimum reserve, huge amount of money. So they had unexploited bracket space. And so there was an arbitrage possibility between the banks in the north and the south, where liquidity was being sent back to the banks in the south, which wouldn't have to pay the penalty interest rate, and the northern banks would save penalty interest rate, and they settled on some interest rate between 0 and minus 0.5 and would both be gaining from it. This is interesting and important insofar as it tells us that the target balances largely result from interest spreads. It has been always a policy of the ECB to reduce the interest spreads. It didn't like the interest spreads, arguing that this would be a disruption of the monetary transmission process and so on. So when the market said we want risk premia because we don't think a particular country is so safe, then the ECB says you're wrong, it is safe, and therefore it reduced these the interest spreads below what the markets would have required, and that led to capital movements. And if we allow the interest rates to follow the markets, the spreads to follow the markets, and if the ECB stops working against it through its policy actions, then there would be a normalization of the target balances. I had completed the manuscript of the book so far, but then came the Corona crisis. And I told my publisher, Palgrave Macmillan, no, we can't finalize the manuscript now. We have to wait what happens. And I expect there will be a capital flight in this Corona crisis. So let's wait for a moment to see what happens. And so indeed, we waited, and indeed, actually, this is where the balances go down in absolute terms. And this is what happened now in the Corona crisis here. The balances diverged even more than before. March was the country with the largest amount of capital flight in the history of the Eurozone in absolute terms. The German balances increased by more than 100 billion euros. There was not a single month before in the history of the Euro with such enormously large capital flows as reflected in the target balances. So the target balances at least give us a picture of the crisis in the Eurozone. It's a thermometer, as some people say, which allows to measure what is going on. But don't forget, it is public credit, which is countervailing the private capital. So public capital goes from the north to the south, and without that, private capital could not go from the south to the north. It's a portfolio balance. Payment orders are a portfolio balance issue between private and public agents. So what's the problem? Is there a problem? Or is it just irrelevant accounting items? I do think there is a problem because there are risks involved. Let us talk about the risks. The obvious risk is that one country leaves the Eurozone. As the treaties say nothing about the possibility of leaving, they say nothing about the liability remaining if you leave. So there is a potential case for saying, I leave and say goodbye, and I don't respect this as a liability, which I would have to pay after having left the Eurozone. And if there is a loss, it is a loss for the Eurozone in total, of course, because of the pooling in the system. All the other central banks that remain bear a certain fraction in proportion to their capital keys of this loss. Certainly, it would not be true to say that the Bundesbank, for example, loses its target claims fully. It participates in the losses of the exiting through an exiting country, period. Mario Draghi was asked about this case by two Cinque Stelle members of European Parliament. I think they must have talked to him before to get this letter. And they said, what happens to the target balances if we leave? And he answered, se un paese lasciasse l'eurosistema, i crediti e le passività della sua banca centrale nazionale nei confronti della BCE dovrebbero essere regolati integralmente. So he said, you have to pay for it. If you leave, you cannot get rid of your target balances. And the Cinque Stelle people liked that because they wanted to show it, this letter to the Lega, which had played with the idea of exiting. But the legal basis of this letter of Mario Draghi is limited, I would say, to put it mildly. There is something to negotiate about. And this in itself is a risk and uncertainty. In particular, it is a risk because even if the exiting country would be willing to respect its liability in principle, it could argue, well, we now have a new currency and this liability will be expressed in our own currency. There's the lex monetae, and therefore I pay back in lira, say. And if the lira value declines, as can be expected, then there would be a loss for the other countries. Because paying back more is not really possible. The assets of a central bank would then be all in lira, and its liabilities would be largely in euros. This wouldn't be possible. A national central bank would have enormous difficulties and might be going into bankruptcy because it can't print the euros anymore. And so I think it's unavoidable that there is a loss for the euro system in this case, even if the exiting country respects its liability. Then there is, of course, a blackmailing risk. Suppose a target creditor country like Germany wanted to leave the Eurozone. There's no way it will be able legally to claim its target balances from the rest of the Eurozone. How can it? And it would not be in a situation like the UK. I'm the least to say Germany should exit. I'm very much in favor of the Euro system. I'm very much in favor of the EU, just to make that sure. I'm just talking about technical issues here. But it couldn't exit because the risk is large that it would lose its entire target claims, not just a fair share of some target losses. The UK has disputed a lot with the Eurozone about a small fraction of the amount of money which is at risk here. And then there is, of course, another risk, which is the asset default risk. Even without exits, the Euro system faces a target risk insofar as a local NCB national central bank may default, being unable to make the net interest payments to the pool that would come along with higher target balances. That is not a trivial point, and there are lots of equations in the book to show what is happening. But just to give you an idea, suppose for a moment we have a symmetrical situation in the Eurozone. Money is being symmetrically distributed according to country size, and the money was created by the respective country where it is circulating. So full proportionality of everything. In this case, the interest revenue of a central bank would have to go to the common EU Eurozone pool, and it would be given back according to country size to the respective national central banks. So basically every central bank would get back exactly what it paid into the pool. And what it has to pay in is actually normally the main refinancing rate. It has to pay that in for public sector purchasing programs, for ELA credit and so on, regardless of what the true rate of return is, which it earns on these assets. Because there is the juste retour rule, which was agreed. There is no risk sharing, so you give the nominal rate of interest to the pool, and that's exactly what you get back. So suppose a national financial system collapses, the state collapses, the banks collapse, and they would not be able to service their liabilities with regard to the central bank. They would not pay the respective interest, and then this central bank could not deliver it to the pool, but no problem, it would receive the same amount of interest from the pool, and it could just in net terms service its obligations. Suppose now we deviate and allow one country to issue extra money through credit operations, asset purchases, or refinancing credit given to the banks. And this extra liquidity is being used for payment orders to other countries. So there are positive balances in negative balances in one country and positive in another country. And as a result of that, there would be, through the pooling, net interest payments through the Euro system from one central bank to another one. The one which has more negative target balances, target debt, from extra assets it issued, would have to deliver the interest through the pool to the other central bank. But it cannot do that if its assets default. And so the other has an extra liability here. An extra risk from not receiving these interest payments. Yeah? One could say, well, the central bank cannot go into default because it can print the money. No, this is not true internally in the Euro system. It has an obligation to extract interest in terms of liquidity and income from the domestic economy, but that is in default, so it doesn't generate that. And then it would have to deliver that to another central bank, and the other central bank could give out this interest revenue it earns through the pooling to the domestic economy by, say, reducing its amount of refinancing credit. The banks receiving the liquidity would automatically perhaps pay back the refinancing credit. So liquidity and income goes from one economy to another one, from the target deficit economy to the target surplus economy. And that process cannot take place when the deficit economy is in default. And therefore there is a target risk in addition to normal risks if the target balances are there, because the target balances in this case, which I analyzed here, is standing for asymmetry in money creation. I mentioned that before, so I can be brief here. The interest on certain assets has to be paid at the main refinancing rate to the pool. So it is not the case that automatically the rest of the Eurozone does not receive interest if we have a symmetrical situation. And the respective country can pay this nominal interest to the pool because it can use its fair share in the total. It just doesn't get an interest back from the pool, you know, and therefore there is no risk for the others. The risk arises if and only if, in my example, if more assets are being issued so that target balances, liquidity flows can occur. And this interest is not just notional. It really means extracting it from the economy and injecting it into the other. And that process cannot take place if a national economy is at risk, is in default, and therefore there is ex ante a risk. And this is a risk, a target risk, which is often not seen because it's a little bit more complicated. It comes in addition to the exit risk. So it is not true, as some people say, that target balances would only be a risk for the creditor countries if there is an exit. No, a local default of the financial system would be of the same kind. So basically the country risk is being borne through the target system by other countries. Then we come to the end by going to the policy conclusions. So what can we learn from the system? First of all, I would say, to be sure that no one throws out the baby with the bathwater, the target system, of course, is useful in principle. It's a sort of shock absorber because capital flight can occur, and capital that had entered a country can be sure that it will always be able to leave. And that in itself excludes panic and fire sales. So it generates financial stability in the Euro system. So that's the plus. However, it may create excessive incentives for capital flows in the first place, and it does eliminate the country risk by imposing this risk on the Euro system. And this inflowing capital, you could say, is a nice thing. It creates a boom, so why not? Well, the boom can become a bubble, and as I explained before Lehman, the 10 years before Lehman was a period of bubble creation in the South, leaving torsos of once competitive economies, overpriced torsos behind. And we do have now the fundamental problem in the Eurozone that the South would have to devalue relative to the North, but can't, at least not easily. And the process of real devaluation is, of course, not advisable because of the terrors for the domestic economy. So I'm not convinced that there are only pluses for the target balances. There is clearly this negative aspect that the target system and this artificial safety it creates for investors that they always can return may generate too much capital inflow and may generate a bubble. And in Europe, the huge capital inflow into the Mediterranean countries before the Lehman crisis meant that in this crisis, a lot of capital wanted to get back home. So the size of the capital outflow, the flight back home, obviously directly was related to the enormous capital inflow in the first years. And as I explained, the target balances have improved the target debtors threat point in negotiations about other means to keep Europe together. So if there is a shaky situation and the risk is that everything is blown up, then the target creditor countries would lose a lot of money, not money, but claims on real resources. And therefore, they might be very hesitant. Good so, you may say, but they would then be willing to agree to rescue programs and transfer systems in the Euro system, which they would, under other circumstances, not have agreed to. And there is a public choice aspect. I want to remind you of this memorandum of the ex-governors of the ECB, Noyer, Larosière, Issing, and others, Claude, who had argued a year ago that the excessive monetary expansion of the Eurozone was not only for purely monetary reasons, but they suspected in this memorandum that the ECB also had in mind the idea to help over-indebted countries to get along in this crisis, which would a fiscal aim rather than a monetary aim, and something for which the parliaments in Europe would be responsible rather than the ECB Council. So there is a public choice aspect involved with the target system. To what extent has all this is all this visible in the time path of the monetary base in the Eurozone? I show this here. On the left-hand side, we have the monetary base, so M0. At the time the euro was introduced, it was half a trillion, sorry. And then it increased. At the time of Lehman, it was 900 billion. And then there were cycles. And before the Corona crisis began, by the end of last year, the stock of money balances had increased to 3.2 trillion. And now it's already in September at 4.4 trillion. So 1.2 trillion extra money balances came into circulation in the Eurozone this year. More than once was sufficient in 2008 for the entire economy. And then the programs already agreed to would imply that by July 2021, we would be in the order of 5.4 trillion euros. So that would be the sixth fold of the stock of money balances in 2008, an enormous expansion. So and then you see what happened basically during the euro crisis. The money was coming out of the electronic and physical printing presses and was going through the credit process into the firms so that they could pay their wages, replacing some of the revenue. And it was primarily going, however, into the government sectors through the asset purchase programs. The governments went into debt, and the ECB, the respective national central banks, bought this debt. So basically, it was financing of the government budgets with the printing press. This is not so surprising. Many systems in the past have found it attractive when they had the right to print money, to print a bit more, rather than extracting more money from the people to finance the government budget. They printed it, and this incentive and was also in the end visible in the Eurozone. It's not only in the Eurozone. I mean, the same thing happens in other systems in Japan and in the United States for, to some extent, similar, to other extents, different reasons. It's a potential inflation risk, I would think so. Of course, there's no proportionality, as we know. Keynes has told us that there is hoarding, that there is a liquidity trap. We are in the liquidity trap, so the money goes under the mattresses, it goes into the stores for money treasures. It goes into deposits that banks hold with their respective central banks. So this would be the base money, the deposit lying there plus the physical banknotes, and they have been accumulated. And how do you see it? You see it by the fact that the other monetary aggregates, which are endogenous, M1, M2, and so on, which include the credit operations of the commercial banks, don't show this development. So the gap between M0 and M1 is the clear indicator that there is a lot of hoarding. And if there is hoarding, this extra money is not so expansionary. It not in the positive and not in the negative sense. It can't create inflation, and this is what we have seen. But suppose Corona is over, the world economy recovers, there's a boom, oil prices go up, import prices go up, wages go up, a wage price spiral begins as we have seen it in the 70s, then there would be an incentive for the ECB to reduce the inflation if it goes beyond 2%, but it would be necessary to go backwards and issue more than 3 billion government bonds, 3 trillion government bonds, which it had accumulated, and give it back to the market, which would depress the prices of these government bonds, bringing banks that hold similar assets in their portfolios into difficulties and generating difficulties for the governments, which would have to pay higher rates of interest. So from a public choice perspective, my estimate is they won't do it. They won't go backwards because it would generate too many problems, and there would be then inflation, which the ECB would not counter. It would probably develop some semantics. It would say, now we have had 20 years inflation below 2%, then we can have 20 years above 2%, and so on. So they would find their way out and let this thing go, but it's dangerous. And the sort of danger which we would see is similar to what Germany experienced after World War I, when the government financed itself through borrowing, and the Reichsbank was buying all these assets excessively, so that the price level went up and the lower middle class was deprived. And 10 years later, found interest in this person who had come to conquer Germany, Hitler. It won't have to be like that, hopefully not. But the horror of what happened in 23 was clearly available and visible still by the Germans, who negotiated in the Maastricht Treaty. And that's why they wanted Article 123, which forbids the monetization of government assets. And you know what happened. The German interpretation was buying these government assets with the printing presses is not allowed, and we will have more than 3 billion euros by next summer, which are bought. So there are certain risks ahead, and they have indirectly to do with the target balances, because they reflect the asymmetric location of this extra liquidity, and to some extent the asymmetric generation of this extra liquidity in the Eurozone. My policy recommendations. So what should we do? I think we need a new goal for the ECB, not just price stability. it should avoid balance of payment imbalances, because that is what target balances are. Not hard constraints which make transfer payments impossible, payment orders impossible. I mean, who could ever think of that? But an incentive to work towards a policy that drives the balances down. And we have seen through the tiering policies how that can be done through interest differentiation between the countries of the Eurozone. That would bring the target balances down. And I guess we would need new rules for the ECB Council. The ECB Council has done much, much more than many people could ever dream of when the Maastricht Treaty was agreed. And therefore, each country was given one voting right. Malta has basically the same voting right as France or Germany. There's something wrong with that. So we need voting according to liability and the capital key, the paid-in capital. And we need majority voting, even for ELA credit. In the moment, it's 1/3 of the votes, which is sufficient to generate, to do the ELA trick and have this asymmetric money creation. It should be at least 50%. And we should ban the ANFA credit, which really doesn't belong into a common European monetary system. Come on, it's not possible to say that each central bank has the right, a certain scope, to print money at its own will and use the extra returns beyond the main refinancing rate to finance the local government budget. And I think we need a settlement system. If you think of my 4 alternatives, we have to move to the third option at least, where the assets which the central bank owns or generates, accumulates by issuing money, are being handed over to the Euro system, at least at the moment when the payment order is made. So that if something goes wrong, the assets are then in the ownership of the Euro system. And I would go further. I would introduce a staggered system of brackets for target balances with progressively rising penalty rates, incentivizing the ECB Council and the local central banks to differentiate the policy interest rates. So my belief that without the proper incentives and the proper framework, the ECB Council will do that by itself is limited. What I've seen in the past tells me that I'm a bit a public choice guy, so you know what that implies. I don't want to go into the details, but I think it would be better to have safeguards, to have a clear changed mandate, to also take the target balances into account and carry out policies that reduce them. Thank you very much for your attention. I look forward to the debate now.
Thank you very much, Professor Sinn, for your excellent presentation.